to push past my limits!
Vlad Ethereum. Alright, so today we're talking about destruction or fucking destruction. The entire US economy. Hyperinflation or Great Depression. You choose. Choose your own adventure. Choose your own adventure. Anyways, so let's get into the video. Slides right here. And let's go. So, destruction or destruction. The US economy. Right. Oh yeah, if you don't know me, I'm Bitcoin genius. Vlad Ethereum. Hold on. Been investing in Bitcoin since April 2021. Have over a year of experience in these markets. Subscribe and turn on post notifications. As crypto geniuses who develop a resilient way of thinking, a quiet way, because we on YouTube and Twitter and on Instagram come across the usual crypto dumbass that's shilling a pump and dump or scamming their followers or blah 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 blah. So just to keep up with the great mind, hit the follow button. Do yourself a favor. This is my Instagram, YouTube, and Twitter. I'm focusing on YouTube only right now, but I use the other ones in various ways. But I mean, I'm not going to go into depth with that right now because it's not what this video is about. So I just before we get started, none of this is financial advice. I'm not a financial advisor. Do your own research. And yeah. So, options for the US economy. We're either going right now we're in quantitative tightening, meaning that the US government is selling off bonds, selling off their balance sheet, taking back the injected dollars from 2020 and taking that back by not only selling off their bonds, but by destroying demand. But by destroying demand, and if everybody else sells off bonds at the same time, we go into a debt spiral, not only because of a potential liquidity crisis, but because of the state of the economy. If it's a depression, how do they get tax revenues? How does the government debt to GDP stay at a under 50% ratio? Government debt to GDP staying under a 50% ratio. You got to answer all these things into question when you look at deflation in an infinite supply economy. Now we have the second option, hyperinflation, which is I think the route that the government is going to ultimately take, because while you can still end up in a depression there, if we just look at the Weimar Republic after World War II, before World War II, whenever it happened, I kind of forgot the timeline on that, but hyperinflation is still a form of devaluation, just not in a literal dollar sense. I would say devaluation still happens in deflation because it's not the literal dollar that's becoming devalued, it's the strength of the economy. So this happens because of federal funds rates raising the rate banks charge each other for overnight loans. Not only that, I believe I'm still doing research on exactly what that funds rate means. But as far as I know, as of right now, I think that also has to do with how much the banks have to leave as collateral with the federal government. Because I'm not sure how the federal government goes about sending them money if they have collateral. Blah blah blah. I'm not sure about all that. But regardless, raising the federal funds rate, which is at the minimum the interest rate for banks and overnight loans, means that if other banks charge each other for loans, that means you're definitely getting more money, or not more money, more interest on your loan, right? That's why interest rates on houses are at 7%, right? Because if banks are getting their money for more, because they have to send the other banks more interest, plus that initial capital, that means for them to make a profit, they have to charge you even more. So this is probably the worst time to get an unfixed 30-year mortgage ever. So Deflation creates a strong demand, as seen on the DXY here. This DXY is the US dollar against the basket of other currencies. The yield curve inversion, which is a reflection of poor economic policy, is also a reflection of not deflation but hyperinflation, as we've seen that was caused by not only interest rate hikes, it was also caused by bond sell-offs, caused by purchasing quantity of goods in sales or price. We're gonna dive into these charts real quick. So we have the yield curve inversion. What the yield curve inversion means is that you would assume that if you hold the bond for longer, it should earn you more money. When right now that's not the case in the economy. Actually, the 2-year yield is reversed, so that gives you more ROI rather than a 10-year yield. So that means that the yield curve is inverted. What a regular yield curve looks like is if, let's say, the 10-year yielded 4.3 and the 2-year yielded 3%, 3.5, 3.8, anything under than the longer term yield. But unfortunately, interest rates, inflation, forward guidance, asset purchases, and quantity and price, like I said before, in shorter time frame bonds, not in shorter time frame bonds, but all those events of manipulation by the Federal Reserve, by the Federal Central Bank, has caused a yield curve inversion due to poor economic policy. You can also see poor economic policy in the housing markets and commodity prices and stock prices as well, as long as in general consumer price index inflation being at damn near I think at least 10-year highs, and along with government debt being at all-time highs for certain. So federal debt is GDP. This is what we're going to talk about, right? So the highest percentage of debt in GDP, it is the highest right now, right? So let's say you have debt, right? Your personal debt. And the percentage I'm not even going to make that comparison. I'm just going to make the real life example. So the government has debt, right? And that debt includes imports and exports to other countries, paying that off, borrowing, paying that off. But that's still money inflows into the general economy. But that is overall too much right now. Because if you have 35% to 36% and going higher of your GDP based upon debt trade alone, that means your economy isn't growing. That means the only thing that's growing is your debt. So if the GDP is growing in a negative way, that means your debt is growing in the worst way possible along with your economy. So that means not only is this crushing demand, because that means with quantitative tightening, the economy is going to shrink. People are going to lose jobs. People are going to have shittier returns, less commodities, selling off commodities. Oil prices are going to skyrocket. I'm going to talk about OPEC later. Gas prices are going to skyrocket. Food is just going to still go up. Basic things are just going to keep going up and up and up and up, right? But what happens is, with that said, the Fed has less money to receive from a healthy economy, which they tried to brute force with an ejection of inflows into the economy. I mean, we had our bull markets from the COVID checks. We had our bull market from all these stimuluses and so on and so forth. With all these PPP, blah, 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 loan, bailout, corporate bailout. It realistically actually made the economy worse because they still took on that debt while the actual real growth of the economy did not improve. Well, it might have improved, but as of right now, that improvement was not enough to take this to keep this GDP level in correlation to debt to GDP level, as the debt is 35% or more, damn near 40% of the economy. What happens if that's 50% of the economy? And so on and so forth. So you get what I'm saying there. Less money for the Fed will change the ratio of debt to GDP. Higher debt, lower economy, lower total economy growth for the worse. Meaning that they can't be any tax cuts, spending cuts to keep the ratios from worsening, right? Because let me put that into perspective. Right, if there's tax cuts, that means they receive less money to pay off the debt. If there's spending cuts, that means not only would they be cutting things like potentially healthcare, social security, people's retirements, military, and we know we live in highly political times where, for the first time in the last 30 years, where all that funding is actually getting put to use, right? Well, besides, the 2001 war, blah, 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 Afghanistan shit, before I was even born, that I don't even understand, really, but whatever. There shouldn't be any tax cuts to keep these ratios from worsening into a minimum, because even if, let's say, because, let's be for real, if the government's going to cut anything, it's not going to be the military. Let's be for real. And it can't be social security, and it can't be healthcare. So what really would be getting fucked up here is infrastructure. But if we fuck up infrastructure of the economy, that means the economy is still going to get worse, which doesn't solve the debt problem. And then if you don't have an income for your debt plus the interest, that means you default. And if the U.S. government defaults, that means essentially that the world's gonna be in entire economic depression, in shambles. So moving on. The best case scenario right now, in my opinion, is to have the same interest rates on the U.S. debt while having the economy grow. Because if we really think about it, if the U.S. government can stay at this debt level for a longer time frame, that means not only are they succeeding in keeping it at a plateau, they can actually start digging into it in an actual payoff, instead of paying off some just to take on even more, paying off some just to take on even more. So there's that. But here's the catch. If federal funds rates continue to rise, demand is going to be crushed. People are going to spend less, crushing federal tax receipts, meaning that the amount the U.S. government takes on for taxes that they get receiving from taxes that they would use to pay off the debt. But if they don't have any tax revenues because spending is gone, capital gains are gone because they crushed demand, then what they have to do is again turn the printers back on and hyperinflate. It's a crazy cycle right now. But here's the thing: if they kept going down that road, not only would they just run out of money, run out of revenues, it would lead to a potential default, especially if the entire world will be selling off U.S. debt. Because you can't have the entire world sell off your debt and them not owning it makes you more profitable, because they bought it for a reason. You needed to get rid of it for a reason. You needed them to buy the debt so that you could have the U.S. dollars in exchange to do more shit with. So moving on. So sources, here's the federal tax receipts. If you can see right there, spiked on an uptrend from 2020 to 2021, spiked the tax revenues in, I believe, the start of 24 in this year, but for the tax revenues of 2021, 2020. 2022, we're seeing lower tax receipts because we've had 2 negative quarters of negative GDP, which means we're in a recession. They changed the definition, but they always do that. They always trying to change the definition of something to hide the truth of the reality of the economy. That's why I don't like these fuckers. That's why I own Bitcoin. That's why I'm off the matrix. That's why my ass is a ghost. That's why I don't even fuck with the banking system at all. But moving forward, right? Because think about it. Why would I put my money in an economy? Not only do they not respect the time of my money to keep the value of my money as an American citizen, the value the same, but they also disregard the fact of everybody else that does the same thing as me. This doesn't have anything to do with the rich, in my opinion. But because the rich don't control how much the money printers are going on unless they're lobbyists and politicians. There's a fair amount of rich people that are self-made and that have struggled. So you can't just group all rich people together and say that it's rich people's fault. And you can't do that either, because you can leverage the rules of our society today to maneuver in a similar manner, like with the LOC, tax write-offs, blah, blah, blah. You follow the rules, regulations. It's a whole lot of bullshit, but it's still accessible to literally everybody. Of course, it takes a certain amount of money, but everything does, right? So moving forward, lower tax receipts, capital gains, blah, 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 blah. Hold on. Yeah, I had to do that. Felt like somebody was gonna call me. Felt like somebody was gonna call my ass. Not fucking this up. So yeah, you can have lower tax receipts, but that's not going to help them pay off the debt. Anyways, so we have right now, as of right now, 36% again of this GDP right now is the U.S. government. So that literally means 65% of the economy is fake. I mean, not fake, real. So if the U.S. economy reaches a higher GDP level, that means that 60% of the economy would then be, and then it can go on and on and on. And that doesn't necessarily mean that the economy has less money per se, but you would have to admit that demand would go down, because that's exactly the goal that they're trying to do with quantitative tightening. So over here you have total percentage of debt as GDP, as total percentage of public debt as a percentage of GDP, right? Skyrocketed within the last 10 years. But now we can see short term, it's been on a downtrend. Why? Why has this actually been on a short-term downtrend? Because number one, we've started engaging in quantitative tightening, meaning that they're trying to remove money out the ecosystem. They're trying to take that money back. So this would happen in correlation with them removing money out the balance sheet. But guess what? As soon as they turn the printers back on, that means they're taking on more debt to do more shit. So that means the percentage might very well go up. But here's the thing: if the printers go back on and the economy is growing, and there's getting those tax revenues, maybe the public debt is going up, which it still will, but maybe the economy is actually growing. That's the only way. But here's the thing: the economy isn't growing right now. The only thing that's changing here is the ratio of the debt, and the economy is staying the same, if not shrinking. So in my opinion, this number doesn't have a choice but to go down if the federal debt goes down slightly faster than the failure of the economy, in my opinion. So although it's going to take a while for the Fed to pivot, it's not going to ever reach a target of 2% inflation. Stomping out demand is going to cause a global depression, along with raising rates. Raising rates is going to eventually cause a depression if they go too hard, because that in itself would ruin the economy, because again, tax revenues, blah blah blah, higher interest rates, less spending, bond sell-offs, strengthening U.S. dollar, which also means if you're in any other country but the U.S., you're facing 10 times worse inflation that we are here. So their central banks, like in Australia, and Japan, and China, and the EU, and the UK, they're all fending for themselves, including potentially Saudi Arabia, because we've just seen them do exactly the reverse of what Biden wanted, and exactly the reverse of what Biden's deal projected and wanted. 2 billion barrels to sell straight to the U.S. rejected. They don't want U.S. dollars. 2 billion barrels cut because they want to control the demand side, and the U.S. government is going to control the dollar side of the petrodollar. So stopping out demand in the economy too much will cause a global depression, along with raising odds of a government debt default, and in that case of crushing demand. With the Fed, Japan, China, the EU, and potentially Saudi Arabia selling off bonds, the government may have to face a flooding of U.S. dollars back to the economy if the sell-off gets bad enough, if the sell-off of bonds gets bad enough, because inverted yield curve. So that means if you're smart, out of anything, you would sell off your 10 years and get 2 years, right? I mean, that makes more sense to me. You might be at a fee. Let's hope it wouldn't be at a penalty greater than the sum of the return on the next investment. But I don't know how that works right now. But either way, sell-off is happening to defend not to defend U.S. dollars, to defend the yuan, the yen, for a fact, the yen. If this sell-off gets bad enough, this will weaken the U.S. dollar and make the U.S. debt worse, because if no one's willing to take on our debt at the expense of propping up their own currency, we may run into a bond market liquidity crisis, as well face higher inflation in all goods, in all commodities and services, but most importantly, natural gas and oil. So what I mean by this, right, if Japan, for example, selling off their debt, selling off U.S. treasuries to gain U.S. dollars to buy back their currency, but that in itself doesn't prop up the yen enough. So they have to get more US dollars to prop back. But the market is getting flooded with US dollars, and those US dollars have to come back to the US some way, somehow. If it's not being traded for other commodities, because again, it's a global reserve currency. But once enough countries get rid of US dollars, they won't want to trade with US dollars. That's what I'm saying. So there's that. The other reason why, let me see what I wrote. The other reason why natural gas and oils are going to go up is because, number one, Russia, one of the biggest exporters of natural gas and oil in the world, what's it called? Sanctioned, blah, blah, blah. But what they're doing is they're selling China. China's reselling to everybody at a markup, at 130%, 300% markup. And then you have OPEC, the other allied power, or whatever you want to call it, allied power government with the U.S., cutting their demand. So they're shrinking the supply, which makes their barrels more expensive to fight inflation, to keep their dollar and economy strong. And not just because what the U.S. government doesn't understand is that it was selfish during the period of the pandemic by printing all these stimulus checks with the world reserve currency, acting like all the other countries didn't depend on the U.S. dollar to buy commodities. So there's that. So next topic, OPEC plus oil changes, bond market sell-off, China gold accumulation. Why can't the U.S. government buy gold anymore? Bitcoin price action analysis. I analyzed the weekly, the monthly, the daily, the 12-hour, 4-hour, hourly, and 15-minute time frame. And why just 13% of one Bitcoin puts you in the top 5% of the world's wealth. And you might not feel it now, and there's a reason why you're not going to feel it now. But on a 10-year term, when you understand that the U.S. government, U.S. dollar isn't going to be the world reserve currency, and you realize there's going to be a facet of currencies that people choose from, a facet of commodities that people choose from, you realize that with your own commodity, that you scooped one of the most rarest commodities in the world as we endeavor into the digital era of society, into the metaverse, blah, blah, blah. We've already seen the powers that be with social media. What I don't understand is how people can second guess this shit again when it's actual currency. I don't give a fuck. I got mine. What people don't understand is, and I'll put in a quick take on that last point. So there's 21 million Bitcoin. Approximately 4 to 6 million of those are lost. Let's just say I have to do another analysis right now, but certain percentage is lost. 14 million Bitcoin to 17 million left. Just with millionaires buying, and 62 millionaires on the planet. And all those millionaires don't just have 1 million, by the way. That's not how that would work. It's just 3% of them buy, because here's the thing. Everybody thinks anybody can just buy Bitcoin. But guess what? That's not true. There's 14 million liquid available. Miners are hoarding theirs because miners want theirs. Companies want theirs, so that's why they're buying them. Banks want them. Countries want them. And now you just have what's left on the exchanges. A mere 2 million Bitcoin. A mere 2 million Bitcoin. And BlackRock, and this is without the aspect of BlackRock and Fidelity and other big governments, first world countries, denominating this as an option for legal tender and or highly liquid commodity. I don't know how, well, I mean, it already is a highly liquid commodity, but why, without announcing that it's able to be traded for XYZ on the spot. So there's that. So and believe it or not, I didn't think this, but apparently most people don't have 10% of a Bitcoin, and that shit blew me. So once you're in the top 5% in Bitcoin, and Bitcoin becomes one of the multiple, because I don't think it's just going to be one world reserve currency. If it is just Bitcoin, then you will be hella rich, of course. Not financial advice, but if it's just, let's say, if it's just one of the 5 available currencies that are commonly traded with, and it takes a certain percentage of the market share of US dollars and gold, then you can expect the price of Bitcoin to be in the high millions. So then again, this price point of 13% of a Bitcoin really just becomes massive. Because think about it, if Bitcoin goes into the high millions, let's say it's $3 million. What's 10% of 3 million? What's 10% of 3 million? 300,000. And then when you think about it like that, who's really gonna have 300,000 to put down for 10% of a Bitcoin? Nobody. Nobody. And that's why we're already fucking rich. We're already fucking rich. We're already done with this shit. Fuck this. I said fuck. I just said, dude. Me buying Bitcoin, everybody Bitcoin is like hijacking the next financial system and brute forcing your way to wealth. That's what it is, in my opinion. In my opinion, that's what Bitcoin lets me do. That's why I fucking love it. So, anyways, moving on. Make sure to subscribe and like for the algorithm. Make sure to comment any new topics that you want to be covered or questions you have about this video. Thanks for watching. Vlad Ethereum. Dude, I gotta stop, bro.